Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back to M&A Unplugged. I'm your host, Domenic Rinaldi. M&A transactions can be hard under normal circumstances. And if you throw into the mix all the uncertainties of the pandemic, it can wreak havoc on transactions. There's no doubt that doing deals is taking longer, diligence is stretched out, buyers are way more cautious, and banks are wanting more and more data about the current and future performance of a business. As in most challenging deal environments, there's always a way to structure a deal to meet the needs of all the parties. I'm being joined today by Joe DeVito, who is the chairman of the business and corporate group of the law firm Howard & Howard. Joe has been doing corporate law and M&A deals since 1995, and he's well-versed in how to get deals done during trying times. Today, Joe shares some creative deal structures to bridge the valuation and risk gaps that we are all dealing with as a result of COVID. He's a smart deal attorney, and I hope you can leverage some of these ideas to successfully close your own transaction, or reach out to Joe. He'd be more than happy to help you explore potential deal structures. Before we get into this episode, however, we have created a best practices and checklist for how to conduct diligence. This is a free resource available on either of our websites, sunacquisitions.com or k2advisor.com. That's K, the number 2, ADVISER.com. Take a minute to download this invaluable resource. It's a great starting point for you and your advisors when contemplating an acquisition. Thank you for being here, and I hope you enjoyed today's episode. Hey, Joe, welcome to M&A Unplugged.
Hey, Domenic, thank you. Thanks for having me.
Yeah, so nice to have you here. Thanks for taking some time. And so you're with the law firm Howard & Howard, and we've been talking about what's been happening in the marketplace, and I know you're seeing some sort of different deal structures. I think we're starting to see a lot of different things based on COVID, and I'm excited to talk about some of the structures that you're seeing. But before we get into that, just take it up a level for us. What are you seeing in the marketplace for M&A right now? What's your lens to the market at the moment?
Well, let's go back to February of last year, for example. I think everyone was uncertain about what was going to happen, and I think the deals that got done after that period were the deals of necessity and the deals that were already in the pipeline. If the financing held up on the deal, if there was financing. And so those deals got done. And what I mean by deals of necessity are ones that were closing out funds, or that a fund felt it had to have to complete the portfolio companies in order to sell the portfolio companies, including bolt-ons. So you saw a lot of that. And then after that happened, then in about the mid-April timeframe, when the pipeline of deals that were already in the works closed out, it got pretty quiet. And then I would say then again, starting around June, when everyone kind of got their bearings, it took off from there, and the deal flow really was like drinking out of a fire hose again all the way through the end of the year. So, yeah. And I think what happened there, what you saw there was that the people realized, the buyers realized the deals that were immune from COVID or that benefited from COVID. Yeah, so those deals were all getting done. And then the sellers, after that short pause, the sellers whose businesses were impacted by COVID got realistic about their multiples. Because if you remember, Domenic, we were coming off all-time highs on multiples, and it was really a seller's market. Yeah. So this was kind of a resetting of the multiple base for sellers whose businesses were impacted by COVID.
Yeah, no doubt. What are you thinking for this year, for 2021? Do you think that you're going to still stay and remain in a robust M&A environment, or do you see things pulling back a bit?
I think it's going to heat up again. It's starting to already. I think it's going to be a strong 2021. I think once the large corporate M&A departments, business development departments kick it into high gear again and come off a pause, it's really going to be a hot year for M&A for sure.
Yeah, it's interesting. What we're seeing is a ton of activity on the buy side, a ton of buyers, trying to source and find deals. And we're seeing a little bit of reluctance on the seller side because they're understanding that if they were impacted negatively or even positively by COVID, that earnouts are going to be a bigger piece of their transaction, it's looking like, or some sort of,
Right.
carve out. And people are struggling with that. I mean, they understand it, but they don't like it. And we see people dragging their feet. I'm not certain that they're going to hold off on going to market, but they're undecided and they're dragging their feet for sure.
Yeah, I've seen both sides of that as you describe it. So on a chemical company deal, when we were representing the seller, they had a big uptick because of COVID, and there was a special valuation as it related to the EBITDA, related to the hand sanitizer and other items that were COVID related. So the seller and the buyer had to bridge that on a positive side.
Yeah.
And then on the downside, sellers were hesitant to sell because they knew they would have a recovery over time, and they didn't want to cash out prematurely and not get the full valuation for their company that they know they would get in another 9 months, for example.
Right. It's so interesting. I mean, it's always been a dynamic market when it comes to M&A, but you've got all these other forces sitting out there like tax reform, right? I mean, we might wind up seeing capital gains go from current 20% to maybe they're talking about 39.6.
Right.
And you wonder, how much do people need to grow to bridge that gap? It's at least the people that I'm speaking to think it's unlikely that we're going to see that this year, but that it may be certainly on the docket for next year. That's going to take a big bite out of net proceeds if we see cap gains go up by that amount.
Yeah, absolutely. We saw a big push at the end of the year to try to get some deals done that could get done by the end of the year.
Yeah.
And again, I think people got realistic about multiples and got it done. I think at the end of the day, when someone's ready to sell or has to sell out of necessity, they're going to sell, and they'll try to structure the transaction to lower the tax impact of that.
Yeah.
But even in historic eras of higher capital gains rates and individual tax rates, well, we still had great deal flow. So I don't see it with the amount of money that's on the sidelines right now with private equity, large corporates, and then the family offices that are just diving into it directly. I think there's such an amount of money on the sidelines that it's got to be deployed.
It does. So, then it begs the question, will we continue to see really high multiples because there is sort of that pressure to deploy all that capital? So it'll be interesting. It'll be interesting to see what happens. Well, I guess we could let's put our crystal balls to the side for a second, because
okay.
Now that we've tried to figure out what's going to happen in the future, I'm really interested to sort of dive into what you're seeing from deal structure perspective. We had an interesting conversation a while back, and it looks like you're starting to see some creative deal structures, and I'm excited to dive into that. So maybe let's start with, obviously, as you referenced here earlier in the conversation, we're seeing a valuation gap, right? Whether it's to the positive side because companies have done so well, or to the negative side because they had a negative impact as a result of COVID. What are you sort of seeing that buyers and sellers are doing creatively to bridge those gaps?
Well, I think the basis of any valuation, as you know, is understanding the numbers and having normalized numbers and recurring sustainable revenue and EBITDA numbers, right? So when you're in the COVID era, it's bouncing all over the place. And so it's either bouncing up to the high side artificially, or it's suppressed artificially because of COVID, right? So what I'm seeing and what we're having happen in deals right now is that people are working off of 2019 numbers. And so what they're doing is they're saying, okay, let's work off 2019 as a base, and we'll look back at 18 and 17 to make sure 19 is a good number, isn't artificial as well for one reason or another. And then we're gonna value the deal on 19 with a couple unique structures to it. So what we'll do is we'll either value it on 19 numbers and have a holdback of say 20% based on a recovery rate that occurs over some period of trailing time after the closing. And what that trailing period is depends really on the type of business and the rate of recovery that industry is experiencing. So if the target company experiences the same rate of recovery, then within that, say, 18-month measurement period, that 20% holdback will be paid. Now, in exchange for that, and with multiples being a little bit on the lower side, in the case of a company that did get impacted by COVID, the sellers are actually asking for earnouts on top of that, where traditionally sellers hate earnouts, but now they're asking for them because they want some upside. That if their recovery rate is in advance of the kind of industry standard, they want to ring the bell one more time.
Got it. So that holdback is truly, a real holdback. I mean, you've got 20% that's being held in escrow, whereas it's not really an earnout. I mean, it might go away if they don't recover, but different than an earnout. Which is, go ahead.
Yeah, and I was going to say, and these are really the deals that we're already pricing kind of pre-COVID. Yeah. So the parties had already kind of had a meeting of the minds as it relates to the price, right? And then you kind of slipped into the deal getting done in 2020, and then COVID hit, and it impacted the financials. So in these instances, you've got folks that had kind of already priced the deal. So, all right, it's a 7 times X. We're going to take 80% of that. We'll pay it cash at closing instead of 100% at closing. Yeah. And then that 20% will be if you hit your recovery within the 18-month period.
Yeah.
Now, the other thing that we're seeing now is we're seeing what you call incremental purchases or creeping acquisitions, right? So we have buyers now, private equity buyers and large strategics that are purchasing a minority interest at a valuation, say, of X in the first tranche, called a first tranche of X minus 1 multiple because of the impact of COVID. And so they're getting in and getting ownership at a lower multiple. And then they set it up so that they have then a controlling interest purchase, which comes in the second tranche in maybe, 3 to 4 years when the company would be fully recovered. And that would be at the original multiple that the parties had kind of agreed upon. And then in that instance, say if you did 20 and then a 40% in that second tranche, and then in the third tranche, the final 40%, you're doing X plus 1 or X plus 2. Okay. So again, there's an incentive for the seller to first of all allow the strategic or the private equity in for less than a control in the beginning, and less than a full multiple in the beginning, because there's upside, say, on 6 years down the road, and those usually end with a maybe a put call type option in year 6.
Yeah. So is the thought behind this that it allows sellers to take some chips off the table today, and it allows buyers to get in and not assume crazy multiple risks?
Absolutely. The purchaser gets to lock up the target. Yeah. And then there are some escape clauses, escape hatches in these deals, but allows them in. They can do continuing diligence as a 20% owner, and then they can decide if they want to, go to the next tranche or if they want to exit. And then the exits are built into the documentation, as a part of the negotiations. And then, as you said, the sellers are happy, in some instances, very happy to have a buyer on board, knowing that there's an eventual exit, an eventual full exit.
Yeah, and so Joe, are the best practices on that deal structure that you're agreeing to a valuation methodology right up front?
Yes.
And X is that regardless of what happens to the company in the next 2, 3, 4 years?
Yeah, I mean, I think to be fair to both sides, having that preordained formula in the documentation allows for the parties to understand and predict what's going to happen. So one way or the other, up or down, right? So if the company performs, we're going to do X. If the company doesn't perform, we're going to do Y. And that's just the way, just the way it's going to fall. So.
Yeah, it's a lot like a partnership buyout scenario, right? You've got a partnership agreement right up front, and you agree on the methodology, and depending on what happens, people can pull triggers or not pull triggers.
That's a really good point, because on the tricky part of these two in structuring was on the governance as well, because there's a flip flop on the control provisions, and the minority owner protection provisions that flop to majority control, and then do they stay the same for both parties, or do they fall off? And of course, the answer is they don't stay the same, because if the strategic or private equity purchaser is by definition going to have full control when they take a majority interest with very minimal downside protections. But when a private equity buyer or a strategic buyer goes in as a 20% owner, they have a laundry list of minority shareholder protections. And again, that's just the nature of the beast and what market terms are.
Yeah, that makes perfect sense. Taking it away from the legal aspects just for a minute.
Sure.
What should owners be thinking about when they're contemplating a structure like this? Because you got a good attorney like yourself, and you're going to button up the documents, right? You're going to make sure there's legal protections. But beyond the legal protections, there's probably considerations, right? Things that owners should be contemplating and thinking about. I mean, they're now getting into bed with a minority investor, whereas they may have run the ship for 20, 30 years by themselves, right? I mean, this is a different kettle of fish.
Right. So in selling to 20%, you have to think in terms of you are giving up control to some degree, and you have to be sure and certain that this is what you want, because once you're in and involved, it's going to progress to the next step. I mean, these things just naturally do, and then have an exit. And I guess the final thing would be for an owner to be positive that they don't want to sell the management or look at some alternative structure. Right. Which raises another point, is that in these creeping acquisitions as well, you do also set up an incentive plan for management, because the PE or strategic wants that, so that the team, other than the main owner, is incentivized to grow it, and everyone's interests are aligned in moving the business forward.
Yeah, that makes perfect sense. I mean, and for business owners, I mean, you've got to think about if you've been the sole shareholder of the business for 20 or 30 years, you now have people in your business. You have people in your kitchen.
Right.
You
Absolutely.
have to know that you're willing to share the kitchen with people, right?
Absolutely.
And really do your diligence. Oftentimes we talk about the buyers doing their due diligence, but the owner has to do theirs as well.
Yeah.
To make sure they're getting into a deal with parties that a party that they want to, be in with for the long haul.
Yeah, and I think it's important, and our clients often do this, and the PE funds that have structured similar deals or that have a number of portfolio companies offer owners to speak to past owners that are now either management or have cashed out, to talk about their experience with the specific PE fund. Yeah. And I do think that's important to do the diligence. And I think it's important to work with a PE fund that has done a number of transactions in the past that are similar to what you're doing. If it's the first time they're doing a purchase of a minority interest, you're going to have to do extra diligence on the front side and extra documentation in terms of all the rights, the relative rights and preferences of the two parties, because if it's the first time for anyone, you're going to have some bumps in the road.
Yeah, no doubt. So let's talk a little bit about liability and getting back to the legal aspects now. Or does anything materially change in the reps and warranties, indemnifications, liability, reps and warranty insurance? Like what's impacted there when you consider doing one of these phased buyouts?
So I think start with the first aspect about liability in a transaction is an asset deal versus a stock deal. And with an asset deal, you're only assuming very certain enumerated liabilities, right? And the rest of it stays with the seller entity. I think with the advent of COVID, we're seeing a lot more asset deals. When we're representing private equity or large corporate on the buy side, we're demanding it's an asset deal because of the PPP loans and the potential liability with that. Yeah. And with all of the regulation that came in so quickly with COVID as it relates to labor and employment laws as well, it's tough to diligence a company the proper way during COVID, right? So if you structure it as an asset deal, you're a lot safer that way as a buyer.
Yeah.
And then I think, and then in terms of the indemnity, we're seeing more escrows, higher cash escrows, and then we're seeing use of transaction liability insurance. But the TLI carriers are not covering certain matters that are related to COVID. So you have to have a separate escrow for that, or an avenue for indemnification.
Yeah, so you got a complete carve out there. That makes perfect sense. I mean, and you're right. I mean, we're seeing, banks still struggling with how to deal with PPP loans in the middle of an acquisition. There's a lot more guidance today than there was 2 months ago, but we still see a lot of challenges here. A lot of advisors not up on the latest in regards to this. So it's so important that you have an M&A attorney that understands this, that's dealing with this day in and day out, and same on the accounting side. I'm sure you're seeing that as well.
Oh, absolutely. I mean, you have to have CPA firms or financial advisors that understand this, that do it on a daily basis, and understand the impact of all the various elements of the target company, whether it's the idle loan or the PPP or just some other aspect of their business that impacts the financial statements, and understanding that and explaining it in diligence.
Yeah. Hey, Joe, going back to EBITDA and multiples a little bit, when you're starting, I don't want to set the question up that way. Let me put it this way. When should a buyer take comfort that they're seeing the business go in the other direction? Or when are buyers really jumping in on a deal? Do they have to see a month or two of recovery? Do they have to see a full quarter? What are they looking for to get some comfort that a structured buyout or an earnout or a holdback makes sense, or they should just walk from the deal?
Right. Is the bottom falling out, or is it just a dip? And is there going to be a true recovery of it? Right. So. I think that we're seeing the diligence period stretched out on purpose because buyers want to have a little more time just to make sure everything's going the way it should be going and the recovery is sustainable. And so I think they're looking at you're looking at 3 to 4 months of seeing some kind of a recovery rate with a step up. So an accelerated type recovery rate. And I think when the purchasers see that, I think they get more comfortable with the deal. And they realize that it's sticky and it's gonna be okay. Yeah. If there's a couple of blips, then they might stretch it out even a little further. I've got a deal right now that's going into literally, it's going to go into 18 months of diligence. It's been extended for another 6 months just because the buyer still wants to do the deal, but they want to kick the tires a little more and see how this recovery comes in 2021. So
it's so funny you should say that. We have a similar type of deal that actually died and came back, and the buyer is just doing an enormous amount. We are on the buy side on this deal. They're doing an enormous amount of diligence. Mm-hmm. But one thing that happened, which was really interesting, is the target company had an accelerated recovery, which wasn't anticipated. When we were in the middle of it, it was really struggling, and the deal fell apart. And soon thereafter, the business turned the corner and had an accelerated recovery. And while our buyer thought they were negotiating a lower price, it's actually turned out to be just the opposite, which isn't all bad news because it's shown how resilient the company is.
Right. Absolutely. Yeah. And so sellers get that confidence when they come back from it.
Yeah.
They get that confidence, and then they demand a higher multiple. They want it to be, They want it to be the way it was 18 months ago, right?
Even beyond that, because it's so resilient.
Yes. Well, exactly. Right now it's COVID, right? So
Now we're COVID proof. Yeah, exactly.
right.
Joe, what other stuff at a high level would be important for our listeners to understand as it relates to, approaching these post-COVID, these COVID deals?
I think we can't forget the other person in the room, and that's the financial institutions and what they're doing right now. And they're a little hesitant right now. There's this whole wave of what's going to happen with PPP and loan defaults in 2021, and everyone's keeping a sharp eye on that. And I'm in a deal right now with a really healthy PE-backed buyer, and their bank, which is one of the big four banks in the U.S., is being very hesitant to loan on a transaction, or not even loan, just allow the use of cash flow on a deal, because the banks are super hesitant right now. So, I mean, I think as a seller, you want to make sure that that everything is okay with their lender, and their lenders approve the transaction. And then I think on the buy side, get out in front of it with your lender, because the lenders, what they're really doing is they're requiring, as we just discussed, Dominic, they're requiring additional diligence, and they want to make sure those numbers are sticky and sustainable, right? And it's going to be an accretive acquisition, right?
Yeah.
So.
Have you seen any I think this is a great point. Have you seen any material changes to the loan documents?
What I've seen is that I've seen the lenders require equity contributions to get a deal done, which, even for private equity clients, which is a little unique, right? Because
that is.
Yeah.
Very unique. Wow. Yeah. We're in a brave new world, and a lot of the people that I'm talking to think we're going to be here for quite some time. That we might have a recovery here, but there's nothing to say that we won't have another dip somewhere along the way, or some other challenges that pop up. And so best we all learn how to deal with this and be creative. And it sounds like you found some ways to do that.
Yeah, absolutely. I echo what you're saying. Strap in for the ride for 2021, because there's a whole new wave of regulation coming, and change, and that always makes for a rough road. So bumpy.
Hey, Joe, just a little bit about your practice. So if you could just, your area of focus,
Sure.
And how people can get in touch with you.
Okay, great. Yeah. So I'm a corporate finance attorney. I have a master's in corporate finance law. And so any type of transaction, finance, M&A, IPOs, secondary offerings, all that kind of good stuff. And I've been doing it now since 1995, and had a steady flow of deals ever since, and a lot of good experience and a lot of great clients. And what I try to do is I try to take that wisdom from the deals, and I try to incorporate it into the deals that I'm working on today, and to benefit the new clients. I could be reached at Howard & Howard. It's jjd@h2law.com is my email. And in the COVID era, I'd even offer out my cell phone, if that's okay, Dominic.
Absolutely, please.
Yeah, so cell phone is 248-765-9090. So shoot me a text or give me a buzz if anyone wants to discuss anything further, for sure.
Well, Joe, I appreciate you coming on M&A Unplugged and sharing your wisdom. These were some really creative ideas that will hopefully give some of our audience thoughts on how they can get their own deal done. Thanks for visiting with us today. Really appreciate it.
Oh, thanks for having me, Dominic. I truly appreciate it. Take care.
Thank you. Bye.
Bye.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.